Hello everybody, it's Tortoise Investing coming at you today with 5 more dividend stocks that you can buy and hold forever. We have 4 stocks and 1 Reit in today's video. If these excite you, you like this type of thing, make sure to hit that subscribe button, join the 556 that have already done so, hit that like button and drop a comment down below. This makes the YouTube algorithm really happy, and that makes me really happy, and I would greatly appreciate it. None of this is financial advice. Just need to put that disclaimer out there. All this for entertainment and educational purposes only. Now, without further ado, we're going to be taking a look at United Healthcare Group, American Express Company, Target, TROW Price, and Crown Castle. So if you came for the list, there's a list. If you want a little bit of more of a deep dive, let's go ahead and dive in deeper. Just a free cash flow yield of United Healthcare is 8.38%. Got a dividend yield of 1.44%. And a payout ratio of 30.6%. I really like this company. It has on a recent high of around $530. So it is down to $476 now. I'm eyeballing this very hard, I won't lie. It's got a 10-year revenue growth of 11.35%. Has a 10-year free cash flow growth of 14.42%. Very nice, just up and to the right. The EPS is growing at a rate of 14.9% as well over the last 10 years. Dividend, 20.98% dividend growth over the last 10 years. That is ridiculous. These are steps. These are stair steps, and they are big O steps. I like that. That is a compounding machine. Shares outstanding, they've not really been doing buybacks all that much, like averaging 0.96% over the last 10 years. It's a company that usually sells at a premium, but I feel like it's not at a bad price right now, especially since the market, I mean, if you're a PE chaser, I think the market's PE right now is like 23, 24, something like that. And then you got, when I say the market, I say the S&P 500. And if you got this thing hovering around 21s, I mean, you might like it. This thing's return on capital employed is 17, 18, and it's been that way forever and a day. It just very reliably stays in that area. They do have a little bit of debt at $54.5 billion. Their EBITDA is $29.8 billion. No issues there in my eyes. If you've seen my stuff before, you know I like to not have more than 3 times my EBITDA in debt. So if this was $90 billion, it'd be a little bit over 3 times, a little bit of a red flag. But it's not, it's like not even 2 times. So no problem there for me, my personal opinion. United Healthcare Group, they have been increasing their dividend over the last 14 years, so not too bad. Next up, got American Express Company. This is a favorite of Warren Buffett. Just free cash flow yield of 12.51%. Got a dividend yield of 1.5%. Payout ratio 22.7%. Revenue's been increased at a rate of 5.29% over the last 10 years. 9.57% over the last 5. Very nice. Free cash flow over the last 10 years is 12.29%. EPS 9.74% growth over the last 10 years. Just up and to the right. Very nice. A very reliable company. They have $43 billion in debt. Their EBITDA is $13.97 billion. You might be like, what? That's, it's breaking your rule. They have $36.8 billion in cash. Not an issue. They have almost as much cash as they do debt. Therefore, that is not an issue to me. The dividend's been increased at a rate of 10% on average over the last 10 years. They did have their little 2020 pause, and then they paused again during a financial crisis. But besides that, you're looking at a step. You're looking at stairs. There were been some big, hefty hikes here. 43 cents to 52 cents, 52 to 60. So a nice compounder. Again, I like it. The thing I really like about it, though, shares outstanding. They buy back shares. Over the last 10 years, I rate a 4%. Over the last year, at 4.8%. So the share count is just going down. And I love that. I love when companies have free cash flow. They're able to give it back to us, the shareholders, in the form of buybacks and dividends. Delicious. Love it. Return on capital employed has pretty much been hovering around this area again for a while. So, but American Express, I like them. They did have to pause back here, so their dividend streak's only like 2 years. But a lot of companies had to pause during the 2020 chaos. Next up, we got Target, free adjusted cash flow yield of 2.44%, got a dividend yield of 3.43%, and a payout ratio of 59.2%. The revenue has been increased at a rate of 8.46% over the last 5 years. Free cash flow, this is where they've been having issues this year. So they have negative free cash flow. That explains the big giant drop that they have had. Let's take a look at the price chart here over the last 1 year. Let's look at the last 5 years. So at the peak there, around August in 2021, hard to believe that was 2 years ago now, they hit 260. And then it's just, it's been a race to the bottom ever since. It's pretty much dropped over 50% since its high. But I like Target. I'll show you why here in just a moment. EPS again, they've been 2023 is beating this company up. So if you were to take 2023 out, it's pretty much up and to the right. It's slowly growing. Their debt $16 billion, their EBITDA is $6.6 billion. Even with the bad year, it's not that bad. It's covered, but it hits the 3 rule that I like. The dividend's been increased. I rated 9.85% over the last 10 years. They did have the smaller hike this year of only 2 pennies, but again, they're having a really rough year. Shares outstanding. They've been buying back shares aggressively. I love that, and they've been increasing their amount of share buybacks when the price is down. Yes, do that. Over the last 10 years, 3.5% average. And over the last year, they've been at 5.68%. That is awesome. I like to see that. If your company is going to be down, take advantage of those share buybacks. Return on capital employed usually hovers around 15, but they're down to 11.37 this year. Again, just a rough year overall. Dividend has been increased over 52 years. So, I mean, they have increased it through the dot-com bubble. They increased it during the financial crisis. They increased it during COVID. This is the little company that could. I like that. Let me show you something here. So, quarterly, we're going to look at the things from quarterly. Their last big drop back in April. So, like, after they reported the negative free cash flow in April, they had that big dip right there in May, at the end of May. They reported positive cash flow this last July, 913 million. The EPS looks like it is still doing pretty well. Return on capital is doing pretty good. So if they can turn out another, 2022 was not nice to them as well. Like, they had 3 quarters of negative free cash flow, and they started the second quarter this year as negative free cash flow too. So if they can turn things around and this next quarter just blow it up, holiday season's coming up, who knows, maybe they can turn things around. And I believe in Target long term. They've been around for a while. They've increased their dividend through the worst of times. And I believe in the company long term. I think they're going to get everything turned around. Again, like I said, they reported that quarter of free cash flow that was positive. Another 1 or 2 of those. And you're going to be looking a lot better. Next up, TROW price. TROW price, just free cash flow yield of 4%. We got a dividend yield of 4.3%, payout ratio a little bit on the high side, but that's okay, and you're about to see why. Revenue's been increased at a rate of 7.94% over the last 10 years. Free cash flow has been increased at a rate of 9.89% over the last 10 years. Both those just up and to the right. EPS 7.15% over the last 10 years. And if you look here, they have $1.76 billion in cash, 0 debt. They have capital leases, but that's like rent for their buildings and stuff, I believe. But 0 debt. This company has no debt. None. They have been increasing their dividend over the last 10 years at a rate of 12.37%, so that's very nice. Shares outstanding over the last 10 years average 1.38%. They've not really been doing too many share buybacks here lately. I wish that they would. That would be very nice. And return on capital employed, 18% back in 2020, in 2019, 18.3, 19.8 in 2020, 30.9 in 2021, 21.21 in 2022. So yeah, I like TROW price. If you look here quarterly, they start this year. Yep, positive free cash flow the first quarter, positive free cash flow the second quarter, growing EPS. We got positive. We got 1.96 and 2. And let's see here. Last year they reported 6.79 for the quarter, for the whole year, and right now they are at 4. So they're on track for $8 EPS, and if they can knock it out these next 2 quarters, this is going to be higher than last year. And it's always good. You want to see this just go up and to the right. I like it. I like them. They've been increasing their dividend for 38 years, so strong company. Again, they've increased it through the dot-com bubble, the financial crisis, the COVID, and just, yeah, I like it. I like a good, reliable company. I like companies with low debt. T. Rowe Price meets those criteria. Next up, our Reit. We got Crown Castle. This thing is beat up. Just a free cash flow yield of 3.8%, a dividend yield of 6.2%. Ain't gonna pay attention to that payout ratio. These pay their things with funds from operations, FFO. They do not pay it from earnings per share. This thing, let's just take a look at the chart here. Over the last 5-year chart, back at the main end of 2021, is $207 a share, down to $100. You can get you a share of this for a Benji. Not that bad. I don't think it's a bad deal. Revenue's been increasing at a rate of 11.13% over the last 10 years. Free cash flow, 16.82% growth over the last 10 years. Very nice, very strong. You like to see that. It's a Reit. Reits carry a lot of debt. That's just kind of how they operate. $20.56 billion in debt. It's not that bad though, compared to some other ones. The dividend's been increased at a rate of 8.38% over the last 5 years, which I feel is pretty good for a company that's got a yield as high as it's got. And they should have another hike coming up here soon. Yes, probably. But yeah, I expect another 6 to 8% more than likely. And going forward, this company's got their financials and stuff in order. I like them a lot. I like them more than I do American Tower, because they have their financial sheet looks a lot better than American Tower. Yeah, if you look at the quarterly here, just free cash flow right there. Look at that. Nice. And the same thing there. They had their highest quarter of revenue since 2019. They had their highest quarter free cash flow since 2019. Since 2020. But yeah, I like it. I like them. If you're looking for a Reit, might be something to look into. Been increasing their dividend over the last 8 years. But yeah, that is 5 dividend stocks, 4 stocks, 1 Reit that you can buy and hold forever. I like all of these, to be honest. And again, always do your own research and stuff before investing or buying anything. Don't just do it because I said that it's good stonk. Oh, just look into it. See if it fits in your portfolio. If it doesn't, it doesn't. If it does, it does. But yeah, hope you enjoyed that. Hope everyone has a fantastic weekend. And until next time, see yous.